Hello and welcome to Moneylife. This is Sucheta Dalal. This week, let's talk about something different. No longer about markets going up and down, but what do we want to invest in? So here's an interesting story. The Reserve Bank of India, you may know, is looking possibly at a plea by Tata Sons, which is a holding company of the Tata Group, that it does not want to go public, doesn't want to get listed, and it will do whatever it takes to remain a private company. Should RBI permit it, or does public interest favor listing? Now, let's go back to the market. You know what happened last week. I've been covering it in my two previous video blogs. The market slumped for one day after the exit polls, shot up again, and thankfully after that has remained fairly steady on a very high plateau. Anyone who invests knows prices of good companies are just too high. In fact, prices of small fly-by-night operators are also too high. This also means that many of you who have been doing monthly systematic investment plans into mutual funds have been giving 20,000 crore every month collectively to various mutual funds. And this money, if it has to get you those returns that you're expecting, has to find its way into stocks of well-managed companies. Well-managed companies means also companies with a large capital base, adequate liquidity, and a fair price. Now, new listings are happening, but not enough. Some of them are a very high price. So investors were naturally thrilled when the Reserve Bank of India told Tata Sons that the holding company has to be listed by September 2025. Now, this is not news. In fact, Tata Sons has been given 3 years to get listed. But soon after the reports emerged, there were news reports, the Times of India and Reuters, that the Tata Group is looking for loopholes to avoid the mandatory listing. Instead, who's going to be your biggest listed company? Believe it or not, South Korean Hyundai Motor Company. It plans to make an IPO to raise 25,000 crore or $3 billion by selling 17.5% of its equity. This does not even include the Kia car business, right? So part of Hyundai is going to be the biggest IPO in India, bigger than Life Insurance Corporation, which raised 21,000 crore and has been the biggest so far. Isn't that a irony? Positive irony. From the time when, multinationals did not even want to come to India, our biggest IPO is going to be Hyundai, a South Korean company, raising money here from us, because obviously Indians have a lot of money in the top 20 percentile. Wouldn't we rather it was Tata Sons? It may not be the biggest, but it'll be up there, right? So we'll wait and see what the Reserve Bank of India and the Finance Ministry does. Do they listen to the Tata Group's persuasion, as they have often enough, or whether Tata Sons will actually be listed? Because that's a good thing for investors, and it's a good thing from the regulatory perspective as well as from the governance angle. Let's look a little closely at Tata Sons. Tata Sons is held by Tata Trusts to the extent of 66%. The Palangi Group is the second largest shareholder with 18.37% stake. The rest is by a bunch of Tata companies. Now, why does RBI want Tata Sons to get listed? It all goes back to infrastructure, leasing and financial services, which defaulted in 2018 September. We broke the story. And IL&FS was a Hydra-headed conglomerate with 347 companies. It had 3 holding companies, the unlisted parent, 2 step-down holding companies, and then all these 347. The unlisted main holding company and its shadowy dealings remained undetected by the RBI right until it began to default and caused a severe systemic shock in the financial system. This was followed by a series of defaults. Diwan Housing and Finance Limited, tens of thousands of crores. Housing Development and Infrastructure Limited, also connected to PMC Bank, Punjab and Maharashtra Cooperative Bank. It took that bank down. The Shrey Group, all these inflicted massive losses on shareholders, depositors, and debenture holders. In response to the IL&FS collapse, RBI introduced what it calls a scale-based regulation framework, SBR framework. This was in October 2021. This framework is supposed to mitigate systemic risks and improve governance. What did RBI do? It divided all NBFCs into 4 layers based on their size, activity, and perceived riskiness. Now, 10 of India's largest NBFCs were classified in the upper layer, which requires stricter governance and oversight since they were systemically important entities. Something happens to them, it creates a systemic shock, like happened with IL&FS. Among these is Tata Sons. One of the conditions for these companies was that they have to get listed. They were given 3 years. That 3 years ends in September 2025. Among these are Bajaj Housing Finance, Aditya Birla Finance, L&T Finance, Tata Capital. All of them have started the process of listing or have got listed already. Tata Sons wants to avoid it. Times of India has recently reported that Tata Sons intends to cut its debt. So it has 21,909 crore of debt in FY 22-23, and it believes that after it's cut it should be eligible for an exemption from listing. In line with this, it has already sold 9,363 crore worth of shares of Tata Consultancy Services, which is its big blue chip stock in the Tata Sons list of companies, and raised this amount of money. The report puts the book value of Tata Sons investments in just 14 blue chip companies at 1.3 lakh crore in 2023 FY. Apart from this, the Tata Sons also holds several valuable unlisted companies, including Air India, which was recently acquired. So if listed, Tata Sons will indeed be one of the biggest listed companies in India. So the Tata Sons management wants to relinquish all public funds in all forms and escape listing, because then it wants to tell the RBI, can you consider us an unregistered core investment company? This is what has been reported. This will involve a lot of sacrifices on its part. On one hand, its articles of association include banking, merchant banking, lending, holding shares, bonds, debentures, providing guarantees. All that will have to stop, and that's big. So will Tata Sons really pay back all bank debt, intercorporate deposits, off-balance sheet exposure, letters of comfort, guarantees, etc.? So the annual report of Tata Sons for FY 22-23 shows that it had an off-balance sheet exposure of 15,000 crores. We're showing you a chart there, and nearly 11,400 crore as soft comfort letters provided to lenders on behalf of its subsidiaries. This is again invested in a whole bunch of companies. Given the enormous direct and indirect influence that the Tata Sons has on its group companies, I'm a little perplexed about how it's going to shed all these businesses and relationships, and will that change be enough, drastic enough, to make it acceptable to the regulator? We'll come to this later. Let's look at why is Tata Sons so reluctant to list? I mean, this big blue chip group, why doesn't it want to go public? The international news agency Reuters has reported one reason. It says, and I'm quoting, one potential worry is that Tata Sons listing will highlight the special treatment that its owners receive and whether that is still deserved. What does this mean? This is now my take. The special treatment, according to me, is twofold. First, the Articles of Association of Tata Sons gives Tata Trusts the ability to control the board agenda of the company, this holding company, by requiring an affirmative vote by the nominee directors of the trust. This obviously is not permitted under the company law, and once it's listed, it will not hold true, it cannot continue. Second, at least 3 Tata Trusts were set up in 1990. Tata Education Trust, Tata Social Welfare Trust, and RD Tata Trust. All of them have a 10% stake in Tata Sons. They, my sources tell me, do not qualify for exemptions claimed by the older Tata Trusts. The older Tata Trusts are Dorabji Tata Trust and Sir Ratan Tata Trust. Now, no trust, no public charitable trust can do anything but keep their money in fixed deposits. The Tata Trusts have been an exception because these trusts were so old that when the new rules came in post-independence, they were given what is called the grandfathering treatment. So Dorabji Tata Trust and Sir Ratan Tata Trust were allowed to do it. My sources say the 3 new trusts are not eligible. In fact, I understand that audit reports of the 3 trusts are qualified with a note to say that their investment in the holding company is against the provisions of Section 35 of the Maharashtra Trust Act. Also, right, apart from what will happen under the Companies Act. Thirdly, there's a strained relationship with the Shapoorji Palangi Group, which continues after the tragic death of Cyrus Mistry. They have a large shareholding, over 18%. They may want to do any number of things, and the Tatas cannot keep them out of management or decision making. Hopefully, they may even be able to buy more shares. So that's a whole different ballgame. Now, should Tatas be exempted from listing is our concern as investors. RBI needs to weigh all of the issues that I mentioned above and several other factors before arriving at a decision. An exemption from listing to the 4th largest NBFC will call into question this great SBR framework that was done in 2021 in response to a default of IL&FS and others. And don't forget, RBI was caught napping in IL&FS. The Serious Frauds Investigation Office has questioned it, and that's why to cover all this up and ensure it doesn't happen again, you have the SBR framework. Will you start giving exemptions right at the word go, just when 10 companies are eligible for in this upper layer and need to be listed? I mean, 10 biggest companies, okay? You start giving exceptions from day one for one of the biggest ones. I don't know how that will go down with anybody, right? The second issue is that Tata Sons and its exposure goes beyond just being debt-free. Like I said, there are guarantees. There's a lot of influence. Now, I'm not saying this. The group holding company has a huge impact on its 6 major listed entities, 6 top blue chip companies. We're not even talking about the unlisted ones like Air India. This is clear from Standard & Poor Global Rating, S&P Global Rating setters, which has put 6 Tata companies on credit watch with positive implications. And it's going to review the relationship between the group holding company Tata Sons and its subsidiaries. This is a note, and here's a link that has come out on 13 June. The review has started on 13 June. And these companies are on a positive rating watch, which means that if they find that Tata Sons is doing a lot for the 6 companies and this relationship is beneficial, it is going to upgrade their credit rating. This tells you the influence that Tata Sons has on the group. S&P Global further says, and I'm quoting, the review will assess whether the potential of extraordinary support for the group entities from Tata Sons is greater than what we previously factored. This is due to increasing operational and management linkages within the Tata Group. Tata Sons has a record of supporting group entities in events of stress. For example, the group provided material, extraordinary financial support to entities such as Tata Teleservices and Coastal Gujarat Power Limited, an erstwhile subsidiary of Tata Power, which has now merged with Tata Power. We are also undertaking the review because we believe operational integration between Tata Sons and group entities, as well as between group entities themselves, will continue to increase. Wow. This is far beyond the kind of linkage and connections that we know about, put very succinctly by a global rating company. As is clear, it's not about selling a bit of debt. In fact, put it simply, it is globally acknowledged that the symbiotic relationship between Tata Sons and the group is not about just cutting debt and letting it remain private. This is for the RBI to note. The systemic implications are far greater, and S&P Global has in fact provided examples. So A, on the continued close involvement of Tata Sons in the strategies of group entities. S&P says that the holding company led negotiations with the UK government for setting up the battery plant and securing government support for the restructuring of Tata Steel's UK facility. That means Tata Sons is going there to do the negotiation and not leaving it only to Tata Steel and Tata Motors or what have you. Second, it says market value of Tata Sons key holdings has increased significantly in the past few years. And this, it thinks, will lead to improved flexibility for the holding company to support group entities. Third, it suggests that if the review concludes that Tata Sons will provide greater support, it will enhance their rating. If it concludes otherwise, the ratings will remain the same. They'll be affirmed. Interestingly, if Tata Sons gives up access to public funds to avoid listing, the flip side is all this flexibility that S&P Global has talked about will actually reduce because it will become hugely dependent on this one big shining star in its portfolio, which is TCS, Tata Consultancy Services. This is going to impact its ability to support group companies more strongly, and it will prevent the enhancement of credit rating of 6 companies. So remember, 6 blue chip companies, listed ones, are going to be impacted by a decision to remain private. And I'm sure going forward, it will affect the fundraising of Air India also, because lenders to Air India will be looking at guarantees and other comfort letters from Tata Sons, which it can no longer give if it wants to get out of all of that to avoid listing. Given these factors, will RBI and the government still allow themselves to be convinced that Tata Sons should remain private? Does it really make sense for Tata Sons to make these great sacrifices? On the other hand, if Tata Sons gets listed, it is undoubtedly the holding company of one of India's bluest of blue chip groups, and people are just going to be waiting to snap it up. It is required to add depth and liquidity to the market. So here's one case where public interest and appropriate application of the rules actually go in hand. Let's see if the government does what is right. If you think that this is the right thing, you should weigh in also, especially if you're an investor. And also, please do subscribe to this channel because you'll hear a lot more like this. Thank you.